Hey, great to have you with us today. We're going to be talking about business lines of credit and most specifically the unsecured type. So those that don't require any collateralization for your home or your business inventory or hard assets or anything like that. These are going to be secured entirely with a solid personal credit profile. So my personal mission statement here for these videos that we're producing for our clients and partners is our main objective is to help you identify your financing options, educate you so that you know what is available in the market, and then determine a strategy based on your goals, short term and long term. And then we connect you with those financing strategies and get you set up with that to achieve your goals. That's pretty much what we do here at Clear Capital Group, of which I'm the business president and CEO. I've been doing real estate in the single family space for nearly 10 years now, and a little bit in the international realm. I'm a financial education enthusiast since high school, so quite a while ago. And my university training is in the medical field, primarily medical laboratory science. So this funding option that we're going to be talking about is creative. It's fast, typically 2 to 3 weeks to funding, highly useful because you can use it for pretty much anything and everything, and it's minimal work for you. We do all of the work on the back end for you and in behalf of our clients, and we'll actually go through that process towards the end of this presentation. So a little bit of history and what unsecured lending is and doing it the right way. There's a lot of people who are doing it, but they're doing it in a very unpurposeful way, I guess you could say. So most traditional lenders like banks and credit unions require the business entities to have a minimum of $100,000 in yearly revenue, 2+ years in business, collateral to offer to secure the loans, and the list goes on and on and on. If you're a small business owner listening to this and watching this presentation, you most definitely know or have experienced a decline for a business loan from a traditional bank and credit union because they have a long list of requirements in order for them to issue a loan to a small business. And of the 28 million small business owners in the United States, and that number fluctuates up or down depending on what resource you find it on, how many of them actually have revenues above the $100,000 mark and those that are less than $100,000 mark? What do you think? Just guessing, you would probably assume that they're just above $100,000. At least that's what I would guess. But actually, here we're going to be talking about your answers right here. 80% of those 28 million small business owners have less than $100,000 in revenue. So, as you can imagine, there are a significant amount of small business owners and entrepreneurs who cannot get bank lending programs or funds to fund their business. They're not even looked at or considered. And so there's all these aspiring entrepreneurs out there trying to make a difference and impact their communities and bring value to the marketplace. And institutional money is being withheld from them. So there's different ways around that so that we can get these businesses capitalized and moving in a positive direction. Between 50 and 80% of businesses fail. Now, we always hear about that, right? Within the first 5 years, 90% of businesses fail or whatnot. Yeah, we hear about that, but oftentimes we don't know the reason or the cause. And according to the SBA, the lack of access to capital is actually the number 2 reason businesses fail. So that goes back to the first slide, the previous slide, which is if you can't get money to expand and market and produce the product and everything, how in the world are you supposed to meet the qualifications to get the loan in the first place? It's a chicken and the egg scenario, and I've personally found myself in this scenario, and it's not a fun place to be in. So we're going to endeavor to elaborate and educate you on one tool or one funding route that is available to you. Target clients are people who would qualify for this type of loan program or capital program, whatever you want to call it. It's not really a loan because these are business credit cards. But what we're going to do is we're going to secure it with a solid personal credit score of 700 plus, sometimes down in the 690s, but preferably 700 plus. Revenues from zero all the way up to $200,000. Startups, real estate investors are very common for this type of program. Why real estate investors? Well, because banks and credit unions find that real estate investing is risky, and so they don't want to lend, even if you have a lot of years of experience and things like that. They just shy away from that altogether. So startups, real estate investors, nonprofits, even companies who have been established, in the mainstream, having business credit cards on hand to manage cash flow, unexpected expenses that come up, it's very wise to have on hand. Just like you would on the personal consumer side, it's good to have a just-in-case credit card that, if you need to pay $3,000 to change your transmission on a car and you can't afford a new one, well, now at least you have some alternative or source to do so. So there are 22,400,000 business owners, based on that 28 million earlier figure, that can qualify or could benefit from this type of program. Again, you're not going to need collateral. So 5 typical funding options that people go through when they're starting a business or thinking about where in the world can I get some funds. Personal savings, oftentimes they liquidate and deploy all of that capital, which from a lender's perspective, that's the wrong way to do it. From a lender's perspective, they want to see, when a borrower's coming to them, they want to see a significant amount of cash hanging out in some reserve account to manage expenses, to manage the debt that they're going to be placing, and so forth. So oftentimes people get that backwards. If you're going to be planning long-term for securing institutional monies or credit cards or anything, you want to preserve that cash and not deplete it. And having access to easily accessible credit is a very easy and smart way to do that. Retirement accounts. A lot of people think, oh man, I can use my retirement accounts. Well, that's great. You can, and we have some very effective programs for getting that out. But sometimes those aren't available, right? Maybe you don't even have any. Microloans. There are many non-depository banks, investment banks, and non-profit institutions, organizations all around the country who will offer microloans, up to $50,000 or something like that to startups with a solid business plan, with a solid market, solid product, all that kind of stuff. Oftentimes they'll go ahead and loan in that arena. And number 4 is the 3S, friends, family, and fools. Kind of joke about that. For friends, you go, hey, I got this great business idea. Would you like to participate? Family, we do the same thing. And then fools oftentimes are going to be people who are not very savvy when it comes to how a business is actually going to operate in the first couple of years. They think it's going to shoot and make millions of dollars within 6 months, and they dump everything into it, and unfortunately they lose out big time. And then number 5, credit cards. Here we're going to be talking about a little bit of facts that have been going around. And if you look down here at the bottom left, Meredith Whitney Advisory Group, they've been in the industry doing a lot of statistics and surveys and things over the years. And here's what they found. Credit cards. 82% of small business owners use them as a vital part of their overall funding strategy. Well, based on the information we learned a little bit earlier that, small businesses can't get bank financing, well, this makes a ton of sense, right? But the difference is that most of these small business owners are using personal credit cards and instead of a business credit card. And we'll talk about the difference here in just a moment. But 82%, and if you're a small business owner, chances are, you are in that 82%. I know that I certainly have been. And so there we go. Used and not used. So 15% of startups, small business owners, have capital from other sources to where they're not using their personal credit cards at that point. Credit cards and credit lines. So banks and lenders canceled, literally revoked over $2.7 trillion in outstanding credit lines by the end of 2011. So from the outset, 2008 through 2011, during that financial crisis that we experienced, lenders basically said, we don't want any more exposure to potential defaults, and so we are going to, put an end to, whatever you want to call it, canceled over $2.7 trillion in credit lines. And only recently, so now it's 2017, we're midway through the year, and banks and credit unions, larger institutional lenders, are starting to open that line back up and offering credit lines, and but the majority of them are still pretty stringent on their qualifications and collateral requirements. So again, it leaves out the small business owner for having access to those types of loans. So there's another issue. Banks and credit unions, they'll pull whatever's the easiest to pull, and it just so happens that would be the easiest in a crisis scenario. So Keybridge research study found that in July 2010 that the effects of small business credit cards on two different aspects, and those two different aspects are small business growth. How did the usage of cards affect the growth, and how did the usage of those cards affect job creation? And here are the results. From 2003 to 2008, more than 1.6 million jobs were created by using credit cards for small business transactions, operating expenses, you name it. In addition, if they broke it down numerically and dollars in, dollars out, for every $1,000 of credit cards spent in a productive small business, that small business could reasonably expect to see a $5,000 revenue created on the back end, thus covering the expense and the cost of using the $1,000 of credit and generating some positive cash flow above and beyond debt service and expenses. So that's pretty interesting, right? And again, if you were to go back and use the same kind of model and put it on institutional bank financing, why wouldn't banks lend in this scenario, right? They're definitely creating value in the marketplace and being able to pay back. So kind of a catch-22 there, but we're going to be talking about the nuts and bolts of the program here, and here's just a small sampling of how an entrepreneur can use business credit cards. Advertising, payroll, equipment, inventory, working operations, whether that be setting up your website, email campaigns, software, customer relationship management software, travel, smooth out your cash flows. Sometimes you got big orders and then they don't pay out for a little while. Fulfill some contracts that you have coming in, hire outside contractors or virtual assistants, rehab or renovation expenses for your real estate, debt service on some other debt that you may have, and the list goes on and on and on, depending on your particular niche that you're serving and operating in. You can think of, and not that you think of, you already have listed most likely a whole list of things that you could use funds for, and these can be used for those. So qualifications for unsecured business credit cards or lines of credit, startups, obviously. Whether you've been in business for 10 minutes or 10 years, we can help. Essentially what we do is, if you don't already have an EIN number, we'll go ahead and get one established and pulled for you. And then these credit cards that will get established for you will report to that EIN and start a very positive process in building business credit as you're growing your business. Anyone in the 0 to 200,000 revenue range would be a great candidate for this program. Existing businesses, we have lines of credit options for clients who are established and been around for a while and have great revenues, and those are going to be the larger bank and institutional lines of credit. And then also on the private side, we have some private lenders who will do the same. So that's a very positive thing to know. real estate investors, fix and flip, buys and holds, wholesalers, creative specialists. For real estate, the list, again, just as an entrepreneur in general, the list goes on and on and on about who can use this type of funding option. Again, here's just a brief guideline as far as qualifications go, and I'll show you where you can get a complete list of those qualifications later on. But low revolving utilization. So this is revolving means your personal credit cards and your other business credit cards that are linked to your personal social security number or credit profile. So we'd like to see 30% or less balance on those cards. And if you're not there, we simply advise you to pay those down to that limit or less before we go through the program. Very few late payments, especially if they're recent. One or two is fine, and you'll still be able to get quality funding, but the fewer the better, obviously. No collections, no public records like bankruptcy, tax liens, or foreclosures within the last several years. 5 or more year old credit file. So that essentially means if you're right out of high school or college or something, and you've never had a credit card, you've never had a phone bill or a auto loan in your own name, chances are you don't have a credit profile established. However, if you, for example, my mother saw fit to help me build my credit when I was a teenager, and she co-signed on a credit card for me. And when I was 15, which was great. And so essentially, what I did is I would buy parts for a VW Bug that I was endeavoring to fix up, and then I would pay it back with a job that I was working while I was in high school. So by the time I got out of college, or even out of shortly after high school, I had 5 years under my belt of a credit history that shows that I know how to manage loans and debts and revolving credit and etc. So that's what that means. We have a minimum of $25,000 or more that you're seeking. If you're seeking less than that, then this program probably won't work, and that will shake out in the fees later on, or the cost of capital that we'll talk about later on. Household income of $35,000 roughly. 5 or less inquiries per credit bureau within the last 6 months. So if you have more than that, then it may just simply be a short-term waiting game to where those inquiries fall outside of that 6-month window, and then that way we can move forward after that. So again, think of these as guidelines. Every situation is unique and different, and that's why we do a little bit of a credit analysis that I will tell you about coming up. In addition, let's say you have terrible credit or you don't have credit at all. Well, you can use a credit partner, and essentially what that means is that this person who becomes a credit partner for you does not have to be tied directly to the business operations. They don't have to be an owner. They don't have to be an employee. They could be your mom who has great credit, who are willing to offer their personal credit to secure this capital for you. And essentially what they'll become is a private lender on your behalf. So we can put credit partners through this program who meet the qualifications, secure the credit, and those credits that you'll be using will still be reporting to an EIN of your choice. So it's still going to be building your business credit profile as you're using these. But you'll just work out an agreement between you and your credit partner to as far as a payback period. Most of these credit cards that we secure for our clients are going to be 6 months to 18 months of 0% introductory rates, which is fantastic, right? You go to a bank and get a loan, and you're going to be paying principal and interest from day one. With these kinds of scenarios, especially for startups, it's amazing that you can actually get 0% money, extremely flexible money, unsecured, and do it for up to 18 months. That's huge, especially if you know that you're going to be generating a return within that 18 months in your business. That means you've effectively borrowed money for free. and generated some ROI in your business to pay back that principal. So that's something you really need to think about. In addition, you only pay on the money that you use. So again, unlike an amortized loan of $5,000 over 5 years or 2 years or 12 months or whatever, as soon as those funds are dispersed or deployed into your account, you have to start paying on the entire amount, whether you actually use those funds or not. With credit, you can draw down whatever you need, use it, and pay it back. And you're only going to be paying interest on that dollar amount that you're using. And in a future slide, we're going to be talking about average interest paid for the clients that we teach and secure this for. And oftentimes, people, from a consumer perspective, they look at credit card interest rates and it scares them to death, right? 24%, 17%. And they're like, holy smokes, that's way too much. It's going to kill me. But what they fail to realize is there's a difference in how it accumulates from a amortized schedule and how credit cards are derived is an average daily balance. So, if that's a new concept to you, then definitely look it up. But that plays a critical role in actually how much interest you actually pay over the term. Enough on that. Credit partner only needs to participate by offering their solid credit profile, and then credit partner will become the personal guarantor, and the business operations will repay that. So there you go. Pretty simple and straightforward. Often when we speak to clients about this program is, can you help me? How much can I get? How long will it take? What will it cost? And how many business credit cards will it take to reach my funding amount? So let's say they need $65,000. Well, oftentimes we can't give you a guarantee. It's going to take two credit cards to meet that amount, because we don't control the dollar amounts issued, because each of the credit issuers have their own criteria and things like that. So what we do is, once we complete the pre-qualification, and by analyzing your credit profile and checking the boxes as far as various qualifications, then we can give you an estimate. Can you help me? Yes or no. How much will I get? Well, based on your profile, we typically see between $40,000 and $50,000 of credits being approved. How long will it take? Well, that's typically 2 to 3 weeks. But oftentimes, if you, the client, are attentive and you're accessible and things like that, well, it could be a lot quicker. But oftentimes, people are super busy. That's completely understandable, and it takes longer. That's out of our control. In essence, that's going to be on you going through the program and the funding process, and that's actually a lot of what goes on with the lending world. It's often the borrower who's holding up the process. What will it cost? We'll cover that. I think you'll be pleasantly surprised. And how many cards will it take? So here we go. Here's some pre-qualification. Here's kind of the breakdown of how it works. So obviously, we're not going to seek funding if we know you're going to get declined. That's a waste of your time. It's a waste of our time. So what we do is we have you set up we have you set up a personal account through a third party. We're not affiliated with them in any way. They're a third party like Credit Karma or something like that. And essentially what you do is you create your profile for yourself or your credit partner that you're going to be using. You send in the login details to me or to our team, and what we'll do is we will log in, we'll assess your credit profile, we'll do a pre-qualification and analysis, and this plan, as you can see, it's $30 per month. You only need to have this service for as long as it takes to get your funding through the process. So if it takes 2 months, well, then you're out $60. If it takes 1 month, well, then you're only out the $30. There's no need to keep it going from month to month. So feel free to call them up and say, hey, I don't need the service anymore. Thank you. please cancel the account, and that's it. No worries. However, if you don't already have an account or you're not monitoring your credit on a regular basis, especially as a business owner, then I highly recommend staying on. What can it hurt? You're educating yourself about how your credit's being creative, what's impacting it, what's not, what's reporting and what's not. So it's a very good service to have anyways, and a lot of people have it for their personal. I think it's just as important to have it for your business as you're building business credit and operating in the marketplace. So who can we help? How can we help? There are several benefits, obviously, and then there's also some cons, as you know, with everything, pros and cons. So what we like to do is these will maximize tax benefits. How? Well, because you can expend, now that you have the capital to expend or expense to use in building your business, thus they become expenses that you can write off when you start generating revenues. Access additional capital, obviously. Minimize interest expenses. Again, that goes back to average daily accumulation and amortized loans comparisons. Obtain cash flow friendly financing. That's referring to the 6 to 18 months 0% interest, which is amazing. Separate your personal and business profiles. A lot of businesses who get started because they don't know what kind of options are available, they start personally guaranteeing and collateralizing their home, their cars, everything, right? And then, something happens and they lose it all. What we try and do, which should be a goal of every business person, is to separate your business life from your personal, especially your assets. This will help get you started in that direction by building a business credit profile, which you can then leverage in the future to get additional capital and business services and things that isn't intimately tied to your personal assets and credit. So we protect and preserve and improve your personal credit profile. How do we protect it? Well, because we divert things over to a business side. How do we preserve it? Again, we put it over to the business side. And how do we improve it? Well, we improve it because these are secured by a personal credit profile, just like on your personal credit cards that you already have, consumer cards. By using them responsibly, it's going to show and report and grow your personal credit as well. So at this point, definitely be asking yourself, how can this benefit my business? What uses can I use it for? And the slide before, most likely you've already identified a whole host of things. So purposeful borrowing, if you're not working with purpose, then you're doing it wrong, right? Especially if you're a small business owner. If you're just spinning your wheels and you're doing things that aren't going to move your business in the right direction, and that right direction would most likely be generating revenues and profits, then I would argue that maybe you're not doing it with purpose. So just a reiteration, we're going to try and separate your business and personal credit profiles. We're going to secure and qualify with personal credit. However, the cards will only report to the business's EIN, which lends into number one. Establish and build business credit for future borrowing. Preserve your backup assets to hedge potential issues. Again, preserve your cash. No need to use all your cash and then leave yourself without that reserve. Provide strategies for proper usage, access, and implementation. We help you do that and give you options for that. Help clients understand and remedy personal credit issues. So while we're doing the personal analysis on your credit profile, if we find some issues, we're going to let you know about them, obviously. And then we're going to tell you, hey, you can do this or this or this to help mitigate that or correct that issue, or we can refer you to somebody who can. Again, how can this benefit your business? Over the last several years, we've done some internal case studies, and we found that on average, after the intro rates end and the traditional credit card rates kick in, our clients are averaging between 5 and 8.96% interest on their credit cards that state, 12 to 24% interest. Well, how is that? How are they actually averaging that? Well, again, it goes back to how credit cards are actually derived on the interest. It's an average daily amount. So if you have $100 on a balance and you have a 12% interest rate, how much you're going to be paying? Well, $12, right? So if you have 3,000 or 4,000 at the end of the reporting period, then you have that 12% being assessed on a larger dollar amount. Compare that with a amortizing loan of $3,000 over the course of 24 months, 36 months or whatever. You're going to be paying the exact same amount of interest every single month, regardless of the principal balance. So in essence, if you can pay down frequently or maintain a very low or manageable balance on your credit cards, you're going to actually effectively be paying less interest than an amortizing loan. Now there's a lot of resources where you can research that and actually see on a spreadsheet how that all works out, and I would highly recommend that you look into that and understand that process. So here's how the program works, and here are the actual steps that we'll be going through so you know exactly what to expect. And this is going to be the same across the industry, not just with Clear Capital Group, but there's a lot of big name companies out there who have a lot of dollars for marketing that you'll see all over the place. Essentially, this is how it works for all of us. Number one, you sign in with a third-party credit reporting group, and prices may vary, but this one, for example, is going to be $30. This is going to allow us to access your personal and business credit profiles if that there's one. So that's number one, set up that profile. Number two, send those login details to us or your other provider, whoever's doing this program for you. They'll do the analysis, and then if the profile is satisfactory on step number three, then we'll have a phone call so we know exactly what to expect, how it's going to affect your credit, time period, fees, expenses, how many cards. So a lot of those questions that clients often ask that we talked about a little bit earlier, that's what this phone call is going to be about. We're going to talk about all of those types of things. Number four, once everything is flushed out, got a lot of questions answered, then disclosures. So, the legal agreements between your provider, Clear Capital Group or another, and yourself. Those will be sent out, signed, and returned. Number five, you will be given access to a secure online portal where you will fill out your own personal information, and this information will then be used by our team to fill out applications. So that's number six, in the most appropriate manner for the credit issuers that we've identified that you will have the highest probability of being approved. Then those applications are submitted. Within 24 to 72 hours, you will begin to be notified of approvals. Now, these approvals will go straight to you on most bases, and so it will be your responsibility to let your provider know, hey, I got a call from American Express, I got approved for this card. And then that way, that communication is going so that everybody knows where everything is on the track, and they can make adjustments or change direction or whatever, open negotiations if need be, as that is progressing. So, and then number 8, as you are approved, then we will assess the fee for the service that we've provided. So the fee, right? The cost of capital. So that's the burning question that everybody wants to know. How much is it going to cost? Here's how it breaks down in the industry average. So the industry average currently is 9%, and I recently spoke to somebody who unfortunately has agreed to pay up to 15% of total credit limits secured on these cards, which is like a hard money loan, which you definitely don't need to pay that much. So for example, to break this down and see how it works out as far as dollars out of your pocket. You get approved for, let's say, 5 cards. Each card has a $10,000 limit, so that's a total of $50,000 of unsecured credit cards that you have been approved and secured. The cost of capital, or the fee based on the industry average of 9%, would come out to be $4,500 for that service. And this would be charged typically onto your newly acquired cards at 0%. So that is oftentimes going to be agreed upon prior to application submissions and things like that. So that's the industry average, 9-10%, and on extreme cases up to that 15%. If you hear that, run. Look for other options. With Clear Capital Group, we are proud to offer the same funding program for our clients for only 5% of the total credit limits to be paid upon successfully securing these cards for you. So we're using the same numbers from the previous example. Let's say you get 5 cards, $10,000 limit each card for a total of $50,000. So the cost of capital, or the fee, that Clear Capital Group would assess for this service would be 5%, or $2,500, which is roughly half the cost of the industry standard. And why can we do this? Because we do volume. We do a lot of volume. And not only that, I have been in the same exact situation as many of you listening to this. I have used these for my own real estate portfolio. I've used it for my own startup companies, and I know that every dollar counts. And so if you're paying, 9-10%, double of this $2,500, if you're paying $4,500, $5,000, $6,000, that has just eaten away a big chunk of your working capital to improve your business situation, right? And so the goal here is to provide a valuable service, but not gut the effectiveness of that capital that you're securing. So that's how we can do that, and that's our justification for charging the 5%. And I think that's pretty fair. So if you have any questions, comments, concerns, please feel free to reach out to me. Give me a call on my mobile, my office. Shoot me an email. Heck, you can even shoot me a text. I'll get right back to you, and we can start the process for you. Description below the video, I'll include a link if you wanted to start that process and get your credit profile established, and then shoot me that information so that I can open it up and do that analysis for you. We can get rocking and rolling real quick. It takes about 10-15 minutes for me to go through that profile, do the analysis, and get back to you with the next steps moving forward. So again, thank you so much for being here for this video about unsecured business credit cards or business credit lines. And again, please reach out. I look forward to talking with you. We'll catch you on the next video. Thanks.